Let me ask you a question. How do you actually know if a stock is worth the risk? Seriously. You see a hot tech stock that everyone's talking about, but it's crazy volatile. Is the potential reward high enough to justify the drama? On the flip side, you see a boring utility stock that just plods along. Is it a safe, undervalued gem or just dead money? The problem is, for most people, investing just feels like guessing. We know that higher risk should mean higher returns. But how much higher? How do you put a number on that? What if I told you there's a Nobel Prize winning formula that does exactly that? By the end of this video, you are going to understand one of the most powerful tools in all of finance. It's called the Capital Asset Pricing Model, or CAPM. And I'm not just going to give you dry theory. I'm going to show you exactly how to use it, step by step, to calculate the fair return you should demand from any stock, so you can finally decide if it's a good buy. So, what is this CAPM thing, anyway? Put simply, CAPM is a model. It calculates the expected return you should get on an investment, based on how risky it is. Think of it like this. You get paid for taking on risk. If you take on zero risk, say, by buying a US government bond, you get a low, risk-free return. If you want a higher return, you have to take on more risk. But here's the key insight. CAPM says the market does not reward you for all types of risk. There are two kinds. Number 1. Unsystematic risk. This is company-specific risk. Like, what if a new product flops, or a key CEO suddenly quits? This risk is a problem for one company, but not the whole market. You can get rid of this risk by diversifying, by not putting all your eggs in one basket. Number 2. Systematic risk. This is market risk. This is the risk you can't get rid of, no matter how much you diversify. It's the risk that the entire economy goes into a recession, or interest rates rise, or a global pandemic hits. This risk affects everyone. CAPM is built on the idea that you only get rewarded for taking on the risk you can't diversify away. That's systematic risk. And the way we measure that specific risk is a single number you've probably heard of. Beta. Beta just measures how much a stock zigs and zags compared to the entire market, like the S&P 500. If a stock has a beta of 1, it moves perfectly in line with the market. If it has a beta of 2, it's twice as volatile. The market goes up 10%, it tends to go up 20%. And if it has a beta of 0.5, it's half as volatile. So, CAPM is just a tool that connects the stock's beta to the return you should expect to get. Okay, that sounds a little academic. Why should you, a regular investor, actually care about this? 3 big reasons. First, it stops you from overpaying. CAPM gives you a hard number, a fair return. Let's say you think a stock will return 9% next year. Is that good? Well, if CAPM says that given its risk, it should be returning 12%, then a 9% return is actually terrible. That stock is overvalued. Second, it helps you build a smarter portfolio. Once you understand the link between beta and return, you can intentionally mix low beta stability stocks with high beta growth stocks to build a portfolio that has the exact risk and return profile you're comfortable with. And third, it helps you find undervalued stocks. This is the big one. If the CAPM formula tells you a stock should fairly return 10%, but your own research shows it's poised to return 15%, you might have just found a winner. Alright, let's get practical. How do you actually use it? This is the formula. Now, I know that looks scary, but do not click away. It's just 3 simple numbers you have to find. I'll show you where to get each one right now. Let's break it down. Component 1. The risk-free rate. This is the easiest one. It's the return you could get on a zero-risk investment. How to find it? Just go to Google and type in the 10-year US Treasury yield. That's the standard proxy. As of right now, let's say the yield is 3.5%. So, risk-free rate equals 3.5%. Component 2. The expected market return. This is the average return you expect to get from the entire stock market. How to find it? This is an estimate, but the most common number to use is the long-term historical average return of the S&P 500, which is right around 10% per year. So, expected market return equals 10%. That little piece in the parentheses is called the market risk premium. It's the extra reward you get just for being in the market, instead of hiding in safe bonds. In our example, that's 10%, minus 3.5%, which is 6.5%. Component 3. The stock's beta. This is the most important one. It's your stock's specific risk. How to find it? You don't have to calculate this. Just go to any major finance portal like Yahoo Finance. Type in your stock's ticker, let's use Apple AAPL as our example. On the summary page, you'll see a number 4 beta 5Y monthly. As of today, Apple's beta is about 1.3. This means it's 30% more volatile than the market. Okay, we have our 3 numbers. Let's plug them in and find the fair return for Apple. Risk-free rate, 3.5% expected market return, 10% Apple's beta, 1.3. Here's the formula again. Expected return equals risk-free rate plus beta times market return minus risk-free rate. Step 1. First, we calculate the market risk premium. 10% minus 3.5% equals 6.5%. Step 2. Now, we multiply that by Apple's beta to find Apple's specific risk premium. 1.3 times 6.5% equals 8.45%. Step 3. Finally, we add that to the risk-free rate. 3.5% plus 8.45% equals 11.95%. So, what does this 11.95% mean? This is the fair return. It's the minimum return that CAPM says you should expect to receive from Apple to justify taking on its 1.3 beta risk. Now, you compare this number to your own research. If you look at analyst reports and you think Apple is only going to return 9% over the next year, CAPM tells you it's a bad deal. It's overvalued. You're taking on 1.3 level risk for only a 9% reward. But if your research leads you to believe Apple is going to return 15%, then CAPM suggests it's a great deal. It's undervalued. You're getting a 15% return for a risk that only deserves an 11.95% return. See how powerful that is? It turns a vague feeling into a concrete decision. Now, manually calculating all this for every stock in your watch list can be complex, and it's easy to get the numbers mixed up. That's why I built a free, easy-to-use CAPM calculator on my website, Fincalconline.online, to do it for you in seconds. It'll save you a ton of time. I'll put the link for that right in the description below. Before you run off and use this for every decision, you have to remember 2 critical things. First, the most common mistake is treating CAPM as gospel. It is a model, not a magic 8-ball. It makes a lot of simplifying assumptions about the market that aren't always true. Second, beta looks at the past. A company's risk profile can change. A small, risky startup that grows into a stable blue-chip giant won't have the same beta forever. The past doesn't always predict the future. So here's the pro tip. Use CAPM as one tool in your toolbox. Don't use it in a vacuum. It's incredibly useful for a first-pass check. But you still need to do your homework on the company's management, its debt, its competitive advantages, and its future growth prospects. So, let's zoom out. What did we learn? 1. The Capital Asset Pricing Model, or CAPM, is a powerful tool to find the fair expected return for a stock based on its risk. 2. It's all about systematic risk, the market risk you can't diversify away, which is measured by beta. And 3. You can use the formula to compare the fair return to your own research to quickly see if a stock might be overvalued or undervalued. So, here's your action step for today. Pick one stock you either own or are thinking about buying. Go to Yahoo Finance, find its beta, and run the numbers. Calculate its CAPM expected return. And to make it fast and easy, your second step is to visit the link in the description and try out the free CAPM calculator on my website, Fincalconline.online. If this video helped you clear up a complex topic, do me a favor and hit that subscribe button for more practical finance videos just like this one. Thanks for watching, and I'll see you in the next one.